Right now, millions of Americans are about to receive a Social Security benefits update that could change everything. If you are currently collecting Social Security or plan to start in 2026, you need to hear this. There is a specific change taking effect that most people will not discover until it hits their bank account. I spent the last 2 weeks digging through the latest SSA announcements so you do not have to. This is not one of those vague updates that does not really affect you. I am talking about real dollar amounts hitting your monthly check starting in January 2026. The window to act on some of these changes is already closing, and most seniors have no idea. If you do nothing, you could leave hundreds of dollars on the table this year alone. My name is Dr. Robert Hayes, and for over 30 years I helped people just like you protect their retirement. I have seen what happens when good people miss a critical deadline or overlook a small rule change. Today I am going to walk you through exactly what is changing with your Social Security benefits in 2026. Stay all the way to the end, because there is a hidden provision that could put an extra $182 a month in your pocket. Let me start with the big picture so everything else makes sense. The Social Security Administration announced a 2.5% cost of living adjustment for 2026 benefits. According to SSA.gov, that means the average retired worker benefit goes from $1,976 to approximately $2,025 per month. That sounds like good news on the surface, but the full story is much more complicated. Here is why that number can be deceiving. A cost of living adjustment is supposed to help your benefits keep up with inflation. But inflation does not hit every category equally. Groceries, medical costs, and housing have all risen faster than that 2.5% figure suggests for most seniors. Think of it like this. Imagine you got a $2 raise at work, but your lunch now costs $3 more. You are technically earning more, but you are actually falling behind. That is exactly what is happening to millions of Social Security recipients heading into 2026. The Bureau of Labor Statistics uses the Consumer Price Index for urban wage earners to calculate your COLA. The problem is that index does not weight medical expenses the way seniors actually experience them. Seniors spend roughly 3 times more on healthcare than younger workers do. So the formula itself may not fully reflect your real cost of living increases. Now here is where the numbers get specific and personal. According to CMS.gov, the standard Medicare Part B premium for 2026 is set at $185 per month. That is an increase of $10.30 from the 2025 premium of $174.70. For many of you, that premium increase will eat directly into your COLA raise before you see a single extra penny. Let me show you exactly how this plays out with real dollar amounts. Say you currently receive the average benefit of $1,976 per month in 2025. Your 2.5% COLA gives you an increase of approximately $49 per month. But after the $10.30 Medicare Part B premium increase is deducted, your net gain drops to about $39 per month. That $39 is what actually shows up in your bank account each month. Over the course of a full year, that works out to roughly $468 in additional income. Now, $468 is not nothing, but it is far less than the $588 annual increase you might have expected. Understanding this gap is critical because it affects every financial decision you make in 2026. But it gets even more specific depending on your income level. If your modified adjusted gross income exceeds $103,000 as an individual filer, you pay higher Medicare premiums. These are called Income-Related Monthly Adjustment Amounts, or IRMA surcharges. According to SSA.gov, those surcharges can add anywhere from $74 to $419.30 on top of your base premium. Let me put that in plain English with a real example. Say you are a single filer with a modified adjusted gross income of $112,000. Your total Part B premium for 2026 would be $259 per month instead of $185. That extra $74 per month means your COLA raise is completely wiped out and then some. Here is what catches most people off guard about IRMA brackets. Social Security uses your tax return from 2 years prior to determine your current premiums. So your 2024 income determines your 2026 Medicare premiums. A one-time event like selling a property or taking a large IRA distribution in 2024 could spike your 2026 costs dramatically. Many of you had life events in 2024 that temporarily inflated your income. Maybe you sold a home, cashed out an investment, or lost a spouse. The good news is that SSA allows you to file a reconsideration using Form SSA 44. If approved, your premiums could drop by $74 to $400 or more per month going forward. I cannot stress this enough because I have seen this mistake cost people thousands. If your income was unusually high in 2024 due to a life-changing event, you have options. You do not have to accept the higher premium without a fight. Filing Form SSA 44 is free, and I will tell you exactly how to do it later in this video. Now let us talk about the earnings test because this trips up a lot of people. If you are collecting Social Security before your full retirement age and still working, there is a limit on how much you can earn. For 2026, SSA. Gov has set that annual earnings limit at $23,400. Earn more than that, and Social Security will withhold $1 for every $2 you earn above the limit. Here is a quick example so you can see the real impact. Say you are 63 years old, collecting Social Security, and earn $30,000 from a part-time job in 2026. You exceed the limit by $6,600, so Social Security withholds $3,300 from your benefits that year. That is $275 per month that simply disappears from your check until the overage is recovered. Now here is the important nuance most people miss about this rule. The money withheld is not gone forever. Once you reach your full retirement age, your benefit is recalculated to account for those withheld months. Your monthly check actually goes up slightly to compensate over time. But in the short term, that missing income can create real hardship if you are not prepared. Stay with me, because what I am about to show you will surprise you. There is a second earnings threshold that applies in the year you reach your full retirement age. For 2026, that higher limit is $62,160 according to SSA.gov. Above that amount, Social Security only withholds $1 for every $3 you earn over the limit, which is much more forgiving. Let me walk through why this distinction matters so much. Say your full retirement age is 67, and you turn 67 in September 2026. From January through August 2026, the higher $62,160 limit applies to your earnings. Starting in September, there is no earnings limit at all, and you can earn as much as you want without any withholding. This creates a powerful planning opportunity that most financial advisors never mention. If you are approaching your full retirement age in 2026, you may want to front-load your earnings into the first part of the year. Or you might choose to delay certain income until after you reach full retirement age. Either way, knowing these exact thresholds can save you thousands of dollars in withheld benefits. Now let me address something that affects nearly every married couple watching this. Spousal benefits in 2026 are still capped at 50% of your spouse's primary insurance amount. If your spouse's full retirement age benefit is $2,400 per month, your maximum spousal benefit would be $1,200. But claiming early can permanently reduce that amount by as much as 30%. Here is where couples make the most expensive mistake I have seen in 30 years. One spouse claims too early while the other waits too long, or vice versa. The optimal claiming strategy depends on your individual ages, health, and earnings history. Getting this wrong can cost a couple $50,000 to $100,000 over a 20-year retirement. Let me give you a specific scenario to illustrate the point. John is 66 with a primary insurance amount of $2,600 per month. Mary is 62 with her own benefit of $900 per month. If Mary claims at 62, she gets her reduced benefit of roughly $675 instead of waiting for a higher spousal benefit later. Had Mary waited until her full retirement age of 67, she could have claimed $1,300 per month on John's record. That is a difference of $625 per month or $7,500 per year. Over 20 years of retirement, that single decision costs them $150,000 in lost benefits. This is why I always say the claiming decision is the most important financial choice you will ever make. Now I want to talk about taxes, because this is the silent killer of retirement income. Many of you do not realize that your Social Security benefits can be taxable at the federal level. If your combined income exceeds $25,000 as a single filer, or $32,000 as a married couple, up to 50% of your benefits may be taxed. Cross $34,000 single or $44,000 married, and up to 85% of your benefits become taxable. Let me show you how this works with real numbers in 2026. Say you receive $24,000 per year in Social Security and have $18,000 in pension income. Your combined income is $30,000, which means you exceed the $25,000 threshold by $5,000. That puts a portion of your Social Security benefits on the tax table, potentially costing you an extra $1,200 or more at tax time. Here is what makes this even more frustrating for 2026 specifically. These income thresholds have not been adjusted for inflation since 1993. Every year, as COLA increases push your benefits higher, more of your income becomes taxable. It is a hidden tax increase that happens automatically, and Congress has shown no interest in fixing it. The practical impact is that your 2.5% COLA raise may push you into a higher tax bracket for your benefits. You could end up paying several $100s more in taxes on the very raise that was meant to help you. Some seniors find that a $49 monthly COLA increase results in only $20 or less of actual spending power. Knowing this in advance lets you plan your withholding and avoid a surprise tax bill in April 2027. Now here is the part most seniors never hear about. There is a provision within Social Security that allows certain beneficiaries to receive a significant increase in their monthly check. It relates to how your benefit is calculated and what earnings years are included. Most people assume their benefit amount is locked in once they start collecting, but that is not always true. Social Security calculates your benefit based on your highest 35 years of earnings. If you have fewer than 35 years of substantial earnings, zeros are averaged into the calculation. Those 0 years drag your average way down and reduce your monthly benefit. Every year you work and earn more replaces one of those 0 years and can boost your check. Here is the specific dollar impact this can have in 2026. Say you have 30 years of qualifying earnings and 5 0 years in your calculation. If you work part-time in 2026 and earn $20,000, that income replaces one of those 0 years. Depending on your overall earnings history, this could add $80 to $182 per month to your benefit permanently. I want to be very clear about how significant this is. An extra $182 per month works out to $2,184 per year in additional benefits. Over a 20-year retirement, that is $43,680 in extra income from one single change. Social Security automatically recalculates your benefit each year you have new earnings, so you do not even need to file paperwork. This is especially powerful for people who took time off to raise children or care for family. Many women in particular have gaps in their earnings record that create those costly 0 years. Even a modest part-time income can make a meaningful difference in your monthly benefit. I have seen clients add $100 to $182 per month just by working part-time for a few additional years. Now let me walk you through the maximum benefit amounts for 2026 so you know where you stand. According to SSA.gov, the maximum benefit at full retirement age in 2026 is $4,018 per month. If you delay until age 70, the maximum climbs to approximately $4,982 per month. But the average benefit is only about $2,025, so most people are leaving significant money on the table. The gap between the average and maximum benefit tells an important story. It means that claiming strategy, earnings history, and timing all play enormous roles in your final number. A person who earns the same total income over their career can receive very different benefit amounts depending on when they claim. This is not about luck. It is about knowing the rules and using them to your advantage. Let me compare two real scenarios for someone turning 62 in 2026. If Sarah claims at 62, her benefit might be $1,480 per month based on her earnings history. If she waits until 67, her full retirement age, that benefit jumps to approximately $2,115 per month. And if she can hold out until 70, she would receive roughly $2,623 per month for the rest of her life. The difference between claiming at 62 and 70 in Sarah's case is $1,143 per month. That is $13,716 per year in additional income for waiting 8 years. The break-even point is typically around age 80 or 81. If Sarah lives past 81, she comes out ahead by waiting, and the average 62-year-old woman today is expected to live to about 86. Now I want to share a calculation that most people never think about. For every year you delay Social Security past your full retirement age, your benefit grows by 8%. That is 8% per year guaranteed, with no market risk and adjusted for inflation. Show me another investment that offers that kind of guaranteed return in today's economy. Of course, delaying is not right for everyone. If you have serious health concerns or absolutely need the income now, claiming early makes sense. The key is making an informed decision rather than just defaulting to the earliest possible age. I have seen too many healthy 62-year-olds claim early out of fear that Social Security will run out. Now let me address that fear directly, because it comes up constantly. The Social Security Trust Fund is projected to face a shortfall around 2033, according to the latest trustees report. But a shortfall does not mean zero benefits. Even in the worst-case scenario with no congressional action, the system could still pay about 79% of promised benefits. Here is my honest assessment after watching this program for 30-plus years. Congress has always acted to shore up Social Security before benefits were actually cut. It is politically impossible to slash benefits for 70 million current recipients. So while the system needs reform, I would not base your entire claiming decision on the fear of Social Security disappearing. Now let me reveal the hidden benefit that most seniors never claim. It is called the Medicare Savings Program, and it can save qualifying seniors between $185 and $600 or more per month. This program pays some or all of your Medicare premiums, deductibles, and copays. According to CMS.gov, millions of eligible seniors are not enrolled simply because they do not know it exists. There are 4 levels of the Medicare Savings Program with different income thresholds. The Qualified Medicare Beneficiary Program covers your Part B premium, deductibles, and copays. The Specified Low-Income Medicare Beneficiary Program pays just your Part B premium of $185 per month. The Qualifying Individual Program and Qualified Disabled and Working Individuals Program serve other specific groups. Here are the approximate income limits for 2026 eligibility. For the QMB program, your monthly income must be at or below $1,275 for an individual. For the SLIM program, the limit is approximately $1,526 per month for an individual. Asset limits vary by state, but many states have eliminated the asset test entirely in recent years. If you qualify for even the most basic level, that is $185 per month, you are no longer paying. That works out to $2,220 per year back in your pocket. And if you qualify for the full QMB program, your total savings could exceed $7,000 per year. The application is handled through your state Medicaid office, and I will give you the exact steps in just a moment. What makes this even more powerful is that enrollment in a Medicare savings program automatically qualifies you for Extra Help. Extra Help is the federal program that pays for most of your prescription drug costs under Part D. According to Medicare.gov, Extra Help is worth an average of $5,300 per year to those who qualify. Combined with the Medicare Savings Program, you could save over $12,000 annually. Now here is exactly what I want you to do this week. First, log into your My Social Security account at ssa.gov and verify your 2026 benefit amount. Check that your earnings record is correct because errors can reduce your benefit by hundreds of dollars per month. If you do not have an online account, call SSA at 1-800-772-1213 to create one or request a statement. Second, check whether you qualify for the Medicare Savings Program by contacting your state Medicaid office. You can find your state's contact information at medicare.gov or by calling 1-800-MEDICARE, which is 1-800-633-4227. Have your income and asset information ready when you call. The application process typically takes 30 to 45 days, so the sooner you start, the sooner you save. Third, if you experienced a life-changing event in 2024 that inflated your income, file Form SSA-44 immediately. You can download this form at ssa.gov or pick one up at your local Social Security office. Common qualifying events include marriage, divorce, death of a spouse, work reduction, or loss of pension income. Filing this form could reduce your Medicare premiums by $74 to $419 per month starting as early as next month. Let me bring it all together with the single most important thing I want you to remember from today. Your 2026 Social Security benefit is not just a number that happens to you. It is a number you can influence through smart decisions about claiming, working, taxes, and Medicare costs. The difference between doing nothing and taking action could easily be $2,000 to $12,000 per year in your pocket. If this information helped you see your benefits in a new light, I would appreciate it if you subscribe to this channel. I put out new videos every week breaking down exactly what these changes mean for your retirement. Next time, I am going to show you a little-known Social Security rule that lets certain divorced spouses collect benefits they never knew they had. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with ssa.gov or medicare.gov.